I've been asked on several occasions to explain dividend investing for beginners. In this video, I'll be covering the basics of dividend investing and why it may just be something that'll interest you. Hey, Frank Thomas here from Wealth Generation Strategies, and I'm going to talk about one of my most favorite topics, and that's dividend investing, especially for beginners. I'm going to be taking some time to get down and talk the real basics of what is a stock, what is dividends, what is growth stocks, what are other products I can buy, what should I buy, the whole 9 yards, the whole enchilada. So today is that video. So stay tuned, and I'm going to get started actually with the very first question that I hear is, so what is a stock? The stock in its most simplest form is a share in the value of a company. You will literally own a piece of that company. For instance, I have several shares of Coca-Cola, so I own a small chunk of Coca-Cola. And you can keep that stock, you can sell it, or you can just reap rewards if it offers a dividend. So it's really up to you. Second, what are dividends? Because we're hearing this word dividends all the time. It's a way to profit share with investors on a monthly or quarterly basis every year, and dividends are normally listed as an amount paid per share. So the amount could be 15 cents, 40 cents, $1.25. It really depends on the actual share that's underlying that particular dividend. So the nice thing about this, though, is dividends are something that you just get as a profit share, and you don't have to sell the stock, which is amazing. So that leads to the question, what's the difference between capital gains and dividends? That's a very good question. So with a capital gain, you're depending upon a rising value of a share price. A good example is you sit on Tesla. I don't think it offers a dividend, but it does. People do profit from it rising in price. So it could be $150 today and $300 tomorrow. And with that rise in price, you can turn around and sell it. That is the downfall. You do have to sell the underlying stock to get the capital gain. With a dividend, though, you'll just obtain that dividend every time it's issued, so you don't have to sell the underlying asset. Capital gains offer much more risk, but also can offer much more profits. So if you've got the stomach for it or the time, over time, most companies will do very well. But in the short run, you can lose or gain 10, 15, 20, I've seen as much as 50% over 6 months, up or down. And one of the big players right now and this is not even a stock, this is cryptocurrencies like Bitcoin, big swings. So you have to have a real stomach for it, and it really depends on your tolerance and your profit window. The longer the profit window you have, in other words, how long you can wait before you got to cash out, the chances of improving how much your capital gains will be in the positive. I have heard many horror stories of people who bought a lot of quality stocks like Apple, Microsoft, Tesla, whatever. And what happens is they have to sell that underlying asset to get any money from it. And in the first few years of retirement, let's say, the price of the stock market as a whole can go down. And they say the stock market's like an insane lunatic. Some days it's trying to sell things way overpriced, and other days it's giving it away. So you got to remember that. There is a lot more chance when you're working with the actual capital gains. Now, these people who are entering retirement in the initial few years, let's say they invested $1 million into these capital gains stocks on the whole pretense that they're going to make money on it and they can cash them in. So let's say they're approaching 65 and it's worth $1 million, and all of a sudden the stock market has a big drop, and it drops by 40%. What is their underlying value of their actual portfolio? $600,000. So whatever they're going to sell is going to be worth less per share than when it was $1 million. And that can significantly impact how long those funds are going to last in the long run. So that's the difference there. Personally, I like to purchase dividend stocks, and I don't worry so much about the actual swing. But that leads me to my next question, and that's number 4. Why should you become a dividend investor? Well, dividends are paid on a monthly or quarterly income basis, and dividends also don't force you to sell the underlying asset. So in other words, if the price goes down, you don't really care. Well, I guess you do care a little bit, but the dividend should not change. And also, you're not really subject to those market fluctuations as much if you're depending upon stock price appreciation. So that's one of the biggest reasons to get involved with dividend stocks. Now, what is the downfall of dividend stocks over growth stocks? And the downfall is you don't get as high a percentage in return. There's less risk, so the returns are less as well. A good example, I had a bunch of 3M stock. They were only giving a dividend of a couple percent, so it was very, very low. So that becomes more of a stock that I'm depending upon appreciation of the value. Now, like I've talked many times in videos saying I really love Coke, and I love Coke because it's kind of an evergreen product. People will buy it when they're poor. Like if they're in a recession, they'll buy Coke. If they're in a boom, they'll buy Coke because it's a cheap luxury. And it's one of the reasons why I like it. And it does offer about a 4 to 5% dividend. So it's not super great, but it's not bad. It's definitely beating inflation. So that's one of the reasons why I really love dividend investing. But you got to remember that. But I'm going to be talking about other products you can buy from an exchange house that can give you better returns. Number 5. So what should you invest in? Starting is always the hardest to do. So start with easy stocks that fall in the Dividend Aristocrat and Dividend King categories. Now, a Dividend Aristocrat is a stock or an ETF that has been paying out a consistent dividend every single time. It could be quarterly or monthly, and it's either staying the same or increasing with time. So they don't miss payments and they don't go down in value when it comes to the dividend payout. Those are, an aristocrat will be 25 years they've been consecutively doing this, and a king is 50 years. Coca-Cola, for example, is a dividend king. It has had consistently paid out dividends of a rising value over time. And if you have a really large window, these are great stocks to have because you might not get a lot of return in the front side of things, but when that stock splits over time, when it increases in value, those dividends will rise as well. And because they've never missed a payment and they've never ever gone down in value, it's a really safe and secure stock to get involved with. Now, there is always risk involved, and you got to do your own research on this. And I'm going to be very blunt about it because I can't be responsible for your portfolio. But the truth of the matter is if you go for dividend aristocrats or dividend kings, you're playing a fairly safe game. Other dividend kings other than Coke are 3M, P&G, a lot of the big banks. But you kind of get the idea. You can actually do a search on the web and see what are the current kings and aristocrats. And also choose stocks from companies that supply goods and services that you already know and trust. Remember I mentioned P&G, Procter & Gamble. They supply shampoos. 3M supplies things like sticky tape. Coca-Cola, that's pretty self-evident. They're supplying Coke. So if you use these products and you know and you trust them, they're probably a good bet for you to invest into. So just something to think about. And also too, as you gain experience, look into products like exchange-traded funds, or short form is ETFs. They offer possibly higher dividend yields, and most of them are monthly payouts. So you can actually build a portfolio that's going to pay you on a monthly basis. So it's like a monthly paycheck, then you never deplete the shares that you have in your portfolio. Also, be sure to diversify your choices. You just don't want to load up on one stock. There's one ETF that I do have a large section of, but for a reason. And it's SVOL, because it's based upon the S&P 500. Now you're going to be asking, what's the S&P 500? It is like a group of all the 500 most popular companies in the United States right here and right now. Now they do change, but the actual underlying trust, the underlying ETF, is actually holding them, and I don't have to worry about that. It's like buying a little piece of Microsoft, and a little piece of 3M, and a little piece of Coke, a little piece of all these companies, and you get a very low share price, and you can get involved very quickly. So it's really nice. Other choices you can look at, and I'd recommend doing it, investing into technology. Microsoft, now these are not dividend, but they're still technology. Microsoft, for example, or Apple, they're technology-based stocks. Banking is another one. Banking and insurance I kind of lump into the same category. That's another one. Banking in Canada could be TD, could be Chase in the States, could mutual or the insurance could be something like Manulife. And I have a bit of all those. Also, you can invest in what are called REITs, and they're called real estate investment trusts. Now, what a REIT is you're, for a very small price, you're buying a piece of a rental. Like it could be a housing rental, like a residential housing rental, or it could be a shopping center. Who knows? Depending on the REIT you choose, or the REITs you choose, like in my portfolio, I have about 4 or 5 different REITs that I'm involved in. Why so many? Because I like to, again, diversify between different markets of real estate. I have ones with the Canadian Tire Corporation. They own things like Marks and Canadian Tire. They own like a number of companies. And all those buildings are underneath that particular REIT. I also have REIT with Plaza. And they mainly have apartment buildings, things like that. So it's a little more diversification, and REITs traditionally pay out a pretty good return. So if you're just looking for something simple, a REIT can return anything from 7 to, let's say, 10% in terms of a dividend. So that's kind of nice. Now, another area is healthcare. In Canada's not a big one, but in the States definitely, because healthcare is fairly privatized in the United States and in other countries. So investing into healthcare or pharmaceuticals is a good place to go. And as I mentioned earlier, the S&P 500 is like a combination. And also, too, consider multiple countries as you gain experience. Choosing different countries, like investing into, like I am in Canada, but I also invest in the United States. But I also invest into Europe. There is some countries right now that I don't invest into because I personally don't feel they're a good risk. And I'm not going to mention those countries' names, but I'll just leave it at that. But I don't invest into those. And I also don't invest into some stocks and ETFs that might be really good, simply because I don't really care for the products. So again, it really depends on you, what you want to choose. So those are all the things you can think about. Before we get to number 6, if you're enjoying this video, give it a like. It tells me this is content you want to see. And if you're really enjoying it, be sure to subscribe. I'm going to be bringing a lot more content like this. So thanks very much. Number 6, what is the difference between a stock and an ETF? And I've mentioned these ETFs, or exchange traded funds, several times. Now, don't confuse it with a mutual fund. A mutual fund and an ETF are very similar. They're basically a basket with multiple stocks inside of it. Now, ETFs have become a lot more popular, mainly because of low management fees. Their management fees are held very low compared to, let's say, mutual funds. As well as, you can buy into an ETF for as little as $10, whereas a mutual fund might cost you $5,000 to get involved in. So those are the differences. Do they have differing returns? Possibly. I believe you can do better with mutuals in some areas and ETFs in others. But one of the most attractive things about ETFs is they do have very low management fees. You can also take advantage of increasing dividends in an ETF, because they'll use other vehicles to increase their profits by doing things called puts and calls on their portfolio. So in other words, they will sell the right to buy or sell their stocks, and it's called a put or a call, and it could raise it a few percent, as well as they will use something called leverage. So they will, within their own brokerage, and they'll work with their exchange house, and they'll say, okay, we're going to be investing $1 billion into all these stocks. Give us a 20% leverage. In other words, give us 20% credit on whatever we've invested into. and they'll invest 20% more of those stocks. And again, that increases the actual rate of return. It does, on the negative side, increase the price swing of that ETF. So be prepared for that. I've noticed that my leveraged ETFs just jump up and down like this all the time. And it really depends on the market. The puts and calls do this as well. So there is more volatility using these vehicles to increase dividends. But again, if you're relying on the dividend and you're not looking at the price, it's not a bad thing to be involved in. Now, there's some ETFs, I'll be honest with you, I got involved with and sold because they have price erosion and the price goes down and it goes down and it goes down. This is one place I would recommend that you look for an ETF that has a little bit of history. Unfortunately, there is no ETF kings or aristocrats. They've only been around, I think, about 7 years, and they've only really become super popular in the last year or so. They don't have a lot of history, which kind of sucks. But in the long run, I would recommend choosing multiple companies to invest into. Hamilton or into, that's the only one that comes to mind off the top of my head. But there's lots of different big companies that offer different forms of ETFs. And that's another way to diversify. You might be invested into one fund that is investing into the S&P 500 with one company, and another company has exactly the same ETF but a different stock symbol and everything else. They might get close to the same returns, but you can take your fund and split it between the two, and now you're reducing your risk of a broker going broke, because you don't want your broker to go broke. That's really bad. So yeah, that's another thing that I do as well, to add more diversification in my portfolio. Now, do I hold hundreds of different things? No. I think my whole portfolio, I'm maybe sitting on 25 to 30 different products in my overall portfolio amongst everything that I'm doing. So I don't have a large holding, probably more than most, but I actively manage mine and watch it and make sure things are okay. Overall, an ETF also on a company can offer a higher dividend and a lower share per entry price. Why is that? Because it's being managed by a secondary vendor, and they're using these other tactics like puts and calls and leverage, and they can purchase more. Like there is one that is on Tesla. This company offers it on Tesla. There's new ones that have come out on Amazon and on Nvidia and things like that. Now they are offering a higher dividend return, or that because the company might not be offering a dividend, or the dividend's very low. That's a way to get a dividend from a company that doesn't offer it. So that's something to look into. Number 7, where do you purchase stocks or ETFs? This is a great question. You just can't go and walk down the street and say, hey, Sam, sell me some Coca-Cola. You just can't do that. You have to register with a registered trading brokerage house. Good examples of this are in Canada, Questrade and Wealthsimple. In the States, Robinhood, Charles Schwab. And also check your local bank. They might actually have a trading division as well, and they can buy and sell stocks for you as well. I've traditionally found, though, that banks have higher management fees, but that seems to be changing as time goes on. So take a look. There is a lot of different ways you can do it. The bank does offer that whole ability to set up a trading account and just move funds from your check-ins account to your trading account, start buying some stocks or ETFs today. So it's great. Look for a good setup tutorials on YouTube. If you're interested in a particular brokerage, that's how I started with Questrade. All my trading accounts are in Questrade right now. I've looked at others. There was things about others I liked and disliked. But go and look at YouTube is a great place to look, and look for videos that show you how to do the actual setup. And that'll be very, very helpful to you. There you go. That's everything that I know about different ETFs and stocks that provide dividends. Like I mentioned earlier, I really love dividend-based products because I don't have to A, worry about the price of it, and B, I don't have to sell the underlying asset itself. So over time, if my portfolio is large enough and I can just take from the dividends and maybe even let some of that dividend goodness increase the value of my portfolio over time and keep it ahead of inflation, works for me. It has also allowed me, because of all these new products coming out in these ETFs, to have a lower balance. I was looking initially, when I was originally doing my initial investing, which is stocks, I was looking at having between 1.5 and $2 million balance, and came to realize there's no way, unless I have a really big lucky break, that I'm going to have that much to invest. And as time goes on, if I do, I will switch back and pull out of a lot of these ETFs. I might always hold a little bit of the ETFs because they still do offer a much higher dividend than normal stocks do. But if you get into the Dividend and Aristocrats Dividend Kings, it's a much more stable and long-term investment to be in, and I like that. So I'll probably get more into those if I do have a balance like that in the future. But with these ETFs, I can gain, like right now, I'm gaining about a 16 and change percent return in just dividends. And that means I only need a portfolio of about $600,000 or $700,000, and I'm golden. I've actually got more than enough money to take care of business on a monthly basis. So I hope that helps you out. And right now you should be seeing a video on the screen that's going to be talking about how to invest into yourself. Now you might think, boy, that sounds a lot like this video. It is, but it's not. This is much more of a general video that talks about the whole mindset of investing into yourself and how you can improve how much more you can be worth. So I definitely recommend, if you enjoyed this video, take a look at that video. You'll definitely enjoy that one as well. Otherwise, Frank Thomas here. Thanks for joining me today. And like I said earlier, if you liked this video, give it a like, subscribe if you haven't, and we'll talk to you in the next video. Frank Thomas here. Have a good day. Bye-bye.